Okay, students, we want to follow up on the last video we didn't quite get to number 9, so let's do it now. Okay, this is talking about what numbers are material and what are the risks that are involved. What kind of risks do we have? So let's take a look, going back to your audit planning PowerPoints. That's the first set. You need to kind of browse through these. They will be on the next test that's coming, so let's take a look. I want you to go down, and the slide we want to focus on is this one. What numbers are material? Okay. Now, the company itself decides what percentage of certain numbers will be material. And as you see here, and you know materiality plays a big part in this, okay? That's what you're saying, that if there's a problem, it has to be a material amount, okay? Not immaterial like for petty cash. So let's determine material numbers here. Some companies say 5 to 10% of net income before taxes. 0.5 to 1% of total assets, 0.5 to 1% of revenue, and 1% of total equity. Okay. So, for example, if you have earnings before taxes of $250,000 at a 5% materiality, then anything over $12,500 that you find to be out of line is considered material. For total assets, if you're auditing those, 150,000 of total assets, and you have a 1% materiality threshold. Anything over $1,500 that you find to be in discrepancy, maybe it's missing, okay, you can't find it, then that's a problem. Revenue or sales, this is a biggie. 500,000 of revenue or sales, if you consider 0.5% of that figure material, then anything that's out of line $25,000 or greater is going to be material. You have missing invoices, for example. You can't find them. Okay, that's your materiality threshold. That seems awful high. Our instinct is to start looking at much lower than that. Equity. Okay, now you're looking at, you have your debt and then your equity down at the bottom, stock, 1%. So if you have equity, which would include your stock holdings, 200,000. Anything multiplying by 1%, anything over 2,000 that you find in the stock would be considered material. Okay, so with that in mind, let's come over and see what Keystone has. Okay, so looking at your problem in number 9. If the company uses 1% of sales and 1% of total asset and 10% of income before taxes, what are their materiality thresholds? So this is a pretty easy one. What you want to do here is take your $92,000, you want to multiply it times 0.01, and that means that anything over $920,000, seems like a lot. Their numbers are much bigger than I thought. So this is 92 million times 1%, 92 million. Okay, so that means $920,000. Anything over that on sales, if it's out of line and you're missing invoices or the sales are off, that's considered material. Again, this is a very large amount. So this company is much bigger than what we think it is. Okay, we're thinking it's a really small, mom and pop kind of company, but based on these numbers, 92 million in sales, 920,000 materiality, that's pretty large. And then we have 1% of total assets. So multiply 13 million times 1%, and that means that anything over $130,000, if you have total assets that are missing or aren't accounted for correctly on your financials, that would be your threshold. And then income before taxes, $320,000. We'll look at 10% of that. Now watch your decimal here because you're looking at 0.10. Okay, and that would mean 32,000 here. So anything over $32,000. Okay. So that's your materiality. Those are the numbers that you would look at. Now, the other thing we want to look at is the risk involved with this company. There's a good set of PowerPoints. Let's go back. We want to get out of the audit plan. Please be sure and go through. This is the next slide. This happens to talk about these three, although there's a whole set of PowerPoints on this. So let's just look at them. There's actually four types of risk involved. Overall, total risk would be the combination of inherent risk, meaning there's a possibility that there's a material misstatement and we didn't catch it. It's just there, okay? Now, because we have internal controls, those controls should catch some of the problems here. If we have anything material, internal controls should weed that out. And then auditors should catch any problems. So inherent risk is overall risk. Control risk has to do with internal control and what they catch. Detection risk is us. Now, what level of risk will these auditors accept? Okay, now I'm going to go to the other set of PowerPoints. Okay, they're down here. And there's a whole set of risk PowerPoints that are involved here. Let's get them to pull up. There they go. Okay, which have a better picture. Let's take a look. Oh, goodness. This is what happens when you're trying to hold the... Okay, keep going. It keeps going away. Now, this explains the risk we're talking about. Possibility that we may unknowingly fail to appropriately modify the opinion that there is a material misstatement. Okay, so it's something that we may not catch. So these are the risks again, same ones I talked about. To get overall audit risk, you multiply the three together. But this is a much better picture of it. So let's take a look at this one. The sand up here represents inherent risk. You have risk, okay? Now, imagine you have a sifter. You pour that sand through that sifter. It's going to catch some of it. That would be your internal control. Procedures to protect your assets. Those are set up by management. We do audit them at times. We do reviews on them. We check them. Okay, but management's ultimately responsible for setting those up. So assume that you don't have proper changing of passwords on technology. You don't have secured assets. You don't have them locked away where they should be. You don't have your employees who handle cash insured. So somebody steals some cash and you don't have the insurance to cover that. Those are some examples. Now, detection risk comes in with the auditors. Here we are. So we didn't catch, the risk goes through internal controls, then it hits us, and we're supposed to try to catch as much as we can. What we don't catch is the overall audit risk. Okay, that's what gets through the sifter. So that's what we're trying to find out. What is the overall audit risk? Now, you can go through and read all of these. It gives you examples. So please do that. Okay, it will be on the test. But this is what we're looking at here in the next example. And there's some other examples here for you to work some problems. Okay, but we want to get down on our audit plan the next portion. Okay, so let's come over here. Okay. Now it says inherent risk is going to be 60%. So 0.60 is our inherent risk. And according to the formula, what we want to do is we want to multiply by control risk. Control risk is 30%. Okay. And then we want to multiply even further by detection risk. Now, again, what we're looking for is audit risk. Audit risk is the risk that there is a material misstatement there that did not get caught. So let's go through these all together again. Inherent risk, there's a 60% chance that there's a material misstatement in the financials, okay? Control risk is 30%. So the difference between these two is the amount that we would catch. Okay, so 30% is control risk. And then we come down to detection risk. There's a 20% chance that we as auditors won't catch something. Okay, 30% chance that it'll get through internal control, and 60% chance that it just exists, period. So what is the overall audit risk that something's going to get through all of those safeguards? If you do the multiplication, what you come up with is 0.036, or convert it to a decimal, 3.6%, which seems a relatively normal amount. So close to a 4% risk that something's going to be missed. Okay, and we'll say the financials are fine, but in all reality, there's something that we did not get. Now, for your help, please go back through and look at these problems, and let's just take a look, because 4% is about what the other problems come out to be. In this one, they were looking at accounts receivable, and there's a 5% risk. So between 4 and 5% seems to be fairly normal. So please go through that. If you have any questions, let me know. Get that all done in class, and have it turned in by Friday for me at 11:59. Okay? Sounds good. Take care.